The American consumer just blinked. For 2 straight years, consumer spending was the one leg holding this economy up. It never wobbled. Last month it did, and almost nobody heard the sound it made. I'm Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. This is your weekend update for the week of August 14th, 2026. The consumer blinked. Let's start with the number that matters most this week. July retail sales came in down 0.6%. The market was looking for a gain of 0.1%. That is a big miss. Now, retail sales always deserve a second look because gasoline is a big piece of the number. When gas prices fall, sales look weaker even if people bought the same amount. So we strip out autos and gas and look again. That number was also down 0.2% when it was expected to be up 0.3%. The weakness held up under a second look. Online sales dropped too. Some of that is calendar noise since Prime Day landed in June this year instead of July. So let's combine the 2 months and remove the guesswork. June was up 0.9%. Put June and July together and the consumer is still down 1.3%. It is a small sample, but this is the part of the economy that has been carrying everything else. Here's what sits underneath that. The savings rate is near an all-time low at 2.7%. More of what people are spending is going on buy now, pay later plans. Delinquencies have not turned up yet, and that is the number to watch next. This is one soft month, not a recession call. But when the strongest leg of the table starts to creak, you listen. Inflation is cooling. So what does this mean for you? It means the inflation story is getting quieter at the same time the growth story is getting louder. Wholesale inflation last week was flat, a 0% reading when the market expected 0.2%. Year over year, it dropped from 5.5% to 4.7%. The core reading, which strips out food and energy, rose just 0.2% against an expected 0.3%, and the year over year number improved from 4.7% to 4.2%. That is two inflation reports in a row coming in cooler than expected. Odds of the Fed tightening have slipped to 40% from 45%. Jobless claims stayed calm. Claims rose 9,000 to 209,000, which is still very low. Employers are holding on to workers they have. Continuing claims held just under 1.8 million, which tells you hiring is slow. Nobody is getting fired. Nobody's getting hired either. The rate outlook. Here's the outlook we are watching. If the market returns to center over the next 2 weeks, that keeps the environment calm. Calm is good for builders who want to build, agents who want to sell, and lenders who want to lend. Oil has stayed technically weak since it failed to fill a gap in late July. Gold has lost momentum and copper is showing weakness. Those three things together take some of the air out of the inflation alarm. The spread nobody talks about. Now let me show you something most people never look at. Mortgage rates do not come from the Fed. They track the 10-year Treasury. As we record this, the 10-year Treasury sits at 4.7%. Last week, it was 4.65%, so the 10-year is slightly higher than it was 7 days ago. The gap between the 10-year Treasury and the 30-year fixed mortgage is called the spread. Historically, that spread runs 1.79%. Right now, it is closer to 1.99%. That's 0.2% of extra cost baked into every 30-year mortgage in America, and it has nothing to do with your client's credit score, their down payment, or their loan officer. Think about what that means. If the spread simply returned to normal and the 10-year Treasury did not move 1 basis point, the 30-year fixed rate would drop about 0.2% on its own. That's the quiet upside sitting in the market right now. It is also why a client who says, "I'll wait for the Fed," is watching the wrong scoreboard. Here are this week's national averages. The 30-year conventional is 6.69%. The 30-year jumbo is 6.83%. The 30-year FHA is 6.28%. The 30-year VA is 6.29%. Rates hit their lowest level in nearly 4 weeks on cooler inflation and softer oil. These are national averages from Mortgage News Daily, not an offer to lend. And remember, strategy beats rate always. The borrower, the tax return hides. Here's one for the CPAs and the planners listening. You have clients whose tax returns do not tell the whole story. Business owners Self-employed professionals, the 1099 earner who runs a real business and pays a real tax bill. Their return shows what is left after every legal deduction a good tax planner can find. It does not show what they actually deposit. We have a set of loan programs built for exactly that person. This week, we're highlighting the bank statement loan. We use the income the client really deposits before their excellent CPA or tax planner takes all the legal deductions that lower their taxable income. Nobody has to choose between smart tax planning and qualifying for a home. Details are at rsrlinks.com/bank statement. rsrlinks.com/bank statement. Featured this week, we shared 3 pieces for you this week. Here they are. Number 1, your household has one real interest rate. Most families have never done the math. Number 2, 1 weak password can undo 10 years of perfect credit. And finally, number 3, from chasing a rate to reading a 30-year map of your own housing market. There are several more on the dashboard beyond these 3. You'll find all of them on the right side of your dashboard or below the video, depending on the device you're using. Debt Done Date, one more tool to put in your hands. It's called Debt Done Date, and you'll find it at rsrlinks.com/DDD. Your client enters every debt they carry: mortgage, auto loans, student loans, credit cards, and unsecured debt. We show them several ways to strategically pay all of it off and the date it happens. Most people have never seen their debts on one page with a finish line attached. It changes the conversation. Send it to clients this weekend at rsrlinks.com/DDD. Next week on the calendar, housing takes center stage. Monday brings the NAHB Housing Market Index. Tuesday, we get housing starts, building permits, and pending home sales. Wednesday brings mortgage applications at 11 in the morning Pacific time. We get the Fed minutes, which will tell us how divided the committee really is. Thursday brings jobless claims and the Philly Fed Index. Friday closes the week with the S&P Global PMI readings on services and manufacturing. This is your weekend update. You can share the entire update with a client at rsrlinks.com/weekend update. We appreciate you listening, and we'll speak to you again next week.